Good morning, happy Friday, and welcome to this week's episode of Sunrise Small Talk. Marlo and I are here to talk more about OBBB, the big, beautiful bill. We're going to talk about charitable giving, we're going to talk about the rates and the brackets, and we're going to talk about the SALT deduction. So here we go. All right, starting with the rates, because I think this is important because as we know, rates are lower kind of across the spectrum, across the board. But another benefit you have, a little bit of a double benefit, and this dates back to 2018, nothing has changed since 2018, is you advance more slowly through the rates. So if I am in, say, a 10% rate, at a certain level of income, I'm going to bump up to the 12 or 15% rate, whatever it may be. In the past, you would accelerate through those brackets and hit higher rates more quickly than you do now, ever since 2018. So a little bit of a double benefit there, and at the end of the day, just kind of the average rate that you end up paying becomes lower, all things equal, of course. Let's talk about charitable gifting, because this was one I got a lot of complaints about back in 2018, and this has been revised. So here's the way this works. Back in 2018, if you didn't itemize, you could, charitable gifting did nothing. You couldn't really take the deduction for it unless you were itemizing. Most people were not itemizing because the standard deduction that we took was so high. So we either itemize or take the standard deduction. If we're just taking the standard, it doesn't matter what we're giving to charity, we're not going to be able to deduct that unless we're over 70 and a half and we did it via a qualified charitable distribution from our IRAs. That was kind of a way to take advantage of charitable gifting for those who take the standard deduction. Now it has changed. So married, filing jointly, a married couple can deduct up to $2,000 of charitable contributions. That is if you are taking the standard deduction. So that's kind of nice. We get our standard deduction, and then if we're giving a little bit of money to charity, we get to deduct that now. I am on the other side of that. I itemize. Now we have a floor that we have to hit based on certain level of adjusted gross income, which is a half of a percent. So what that means is basically, unless someone who is itemizing gives a certain dollar amount, they aren't going to get credit for it. So you have to give over 0.5% of your adjusted gross income to charities before that deduction can be stacked on top of your other itemized deductions. Last thing I want to talk about, doesn't really affect us here in Colorado a whole lot, but the SALT cap deduction that has gone from $10,000 up to $40,000. And what that is, SALT stands for state and local taxes. You get to pick, so with your state and local taxes, you can choose to deduct the income or the sales tax. You pick. In Colorado, our tax rate used to be 4.65 forever, and they keep changing it. So now I'm going to have to try harder to remember it. 4% in 2025. Sales tax is 2.9%. Well, how do I know which one to pick? Well, more than likely your CPA, your accountant, or your accounting software will calculate that for you. But if you spend a lot of money and have a cheap house, you're going to pay way more in sales tax. Vice versa, if you have a really nice house and don't spend much money, you're not going to pay a lot in sales tax, but you are going to pay a lot in state and property taxes. So it's kind of the decision you make there. You get to deduct the income tax either way, and then you decide if you want to deduct property tax or sales tax as the second component of that. So there you go. Have a great weekend. Finally getting some cool weather, which is kind of nice. Take care, and we'll see you next time.